The market's always buzzing about something. And lately, it feels like every other headline is screaming about the hottest new company, right? Finally hitting the stock exchange.
Yeah, everyone's talking, getting on the ground floor, imagining those overnight fortunes.
Exactly. It's this rush, this excitement, this pure promise of striking it rich with the next big thing. But, if you step back from all that fanfare for just a second, is all that hype around an initial public offering, an IPO?
Yeah.
Is it truly justified for you, the average investor? What's really going on behind that shiny public debut?
Well, that tension you're talking about between the palpable excitement and frankly, the underlying reality. That's precisely what we're digging into today.
Right.
An IPO, it's a massive event in the financial world. It's that moment a private company basically opens its doors, sells shares to the public for the very first time, and it's always framed as this incredible opportunity. But as this stack of sources we've been poring over clearly shows, the picture is, well, it's a lot more complex. And honestly, it comes with some pretty serious warnings.
Absolutely. And for this deep dive, we've pulled together a whole range of material. We've got recent market reports giving us the pulse on the current U.S. IPO scene.
Right, the latest trends.
Yeah, and detailed guides explaining the mechanics, how companies go public, how they wrestle with that crucial initial valuation. And crucially, we've looked at some serious academic research, stuff that tracks the long-term performance of IPO stocks.
Which gives us that historical perspective, right? Beyond just the first-day excitement.
Exactly. Beyond the pop. We've also got legal perspectives on the complex regulatory hoops companies have to jump through. And maybe most revealingly, insights and skepticism from individual investors, people who've actually navigated these waters.
And our goal with all this material, it's really singular.
Yeah.
Cut through the noise, cut through the marketing, the sheer volume of hype. Yeah.
By dissecting these sources, we're aiming to give you a solid understanding of what the U.S. IPO market looks like right now. Peek behind that elaborate curtain of how companies actually transition to being public, figure out that initial share price. And most importantly, stack those potential, often hyped rewards against the very real and, let's be honest, often significant risks involved.
It's really about arming you with the knowledge you need. Not just so you follow the crowd or chase a headline, but so you can make truly informed decisions about when and if investing in an IPO makes sense for your own goals.
Okay, so let's start unpacking this. Maybe begin with the overall landscape. We often hear about IPO waves or cycles. Where are we now? What did, say, 2024 look like in the U.S. market?
Right. So diving into those market reports, particularly the EY-US IPO Trends Report for the end of 2024, the main theme is really one of significant recovery compared to the year before. It wasn't like the crazy pace of 2020 or 2021, but there was a definite positive momentum building up. Right. And the numbers, they really bear that out pretty clearly, don't they? I mean, the total number of IPOs jumped noticeably, something like 38%.
Yeah.
And the total money raised, the proceeds, that rose even more by 48%.
Wow.
Which tells us, it wasn't just more companies coming to market, but the average deal size was getting bigger too, suggests maybe more investor appetite for the bigger names.
Exactly. And the report highlights this scale. Get this. 20 different deals managed to raise over $500 million each.
Okay, that's substantial.
Yeah. And 7 really large ones topped the $1 billion mark. And if you look just at the end of the year, Q4 2024, proceeds actually doubled compared to Q4 2023.
Doubled.
Yeah, although a single massive USD 1.7 billion deal late in the year played a huge part in that. It accounted for like 30% of the total proceeds just in that quarter.
So a few really big offerings can definitely skew the picture quickly.
Oh, for sure.
And where was this activity happening? Which sectors were leading the charge?
Well, the leaders for deal-making in 2024 were, maybe not surprisingly, healthcare and that broad category of TMT technology, media, and telecom.
Yeah, makes sense. Often seen as the growth and innovation hubs, which is exactly what companies looking to go public want to project.
Right. And looking ahead from that 2024 picture, there's this building sense of optimism for 2025. The expectation seems to be that favorable market conditions, maybe combined with shifts in monetary or fiscal policies, could create an even more welcoming environment for IPOs.
And this is a really crucial point, the sources keep hammering home the IPO market is deeply, profoundly cyclical.
Right. It doesn't just go straight up.
No. It has these periods of high activity, then lulls. And this ebb and flow, it's not random at all. It's heavily influenced by, broader economic conditions. How's the economy doing overall? Investor sentiment plays a huge role, and that can flip from bullish to cautious really fast. Monetary policy, fiscal policy, think interest rates, government spending that affects the cost and availability of capital.
Big time.
And of course, market volatility, those sudden swings up or down, plus the whole geopolitical and regulatory climate. All that can open, or just as quickly slam shut, that critical window for a company to go public successfully.
Understanding that cyclical nature, it gives us context, right? Like, we saw a period of relative stability in the U.S. IPO market from, say, 2017 until 2020 when COVID just changed everything.
Right.
That year, 2020, saw a huge surge. 457 IPOs, raising $168.3 billion. But a big driver there wasn't just traditional companies. It was SPACs.
Ah, the special purpose acquisition companies. Yeah, those blank check companies raising money specifically to buy a private company later. They were everywhere for a while.
Exactly. And then 2021 was just extraordinary. Over 1,000 IPOs, 1,006 raising a combined $316.6 billion.
Whoa.
And while SPACs were still part of it, that was also the most active year for traditional IPOs, an actual operating company going public directly since the dot-com boom. 393 traditional deals raising $154 billion.
That's massive.
That's the year we saw those huge, highly anticipated deals like Rivian, the electric truck company. Their IPO raised over $12 billion, made the second largest U.S. IPO ever at the time.
I remember that. And for a hot second, their market cap was bigger than Ford or GM, right?
Yeah.
Based purely on that IPO valuation.
Exactly. It just perfectly illustrates the scale of capital and, the level of sheer market excitement, the hype that an IPO can whip up.
Indeed. Okay, so we've got the market context, recovery, optimism, but always tempered by that cyclical reality. Now let's pull back the curtain a bit. What actually happens when a company decides to make that enormous leap from private to public? What's that journey really like?
Well, at its core, the main motivation for most companies going public, and this comes through implicitly in all the sources, it's about accessing a huge pool of new equity capital.
Right, money for growth.
Money for growth, expansion, R&D, maybe paying down debt. But beyond just the cash, becoming a public company gives them way more visibility, brand recognition. And it can make it easier to use their stock for things like acquisitions or employee incentives.
Yes, and the sources offer some really practical advice for companies gearing up for this. It's definitely not a decision you make lightly or execute quickly.
No kidding.
A key piece of advice is for companies to focus intensely on what they call near-term actionable growth drivers, meaning concrete things the company can point to right now that are driving revenue or market share, stuff they can actually demonstrate to potential investors when they hit the roadshow, not just pie-in-the-sky promises.
Gotcha. Makes sense.
They also need to make sure their business and financial models are rock solid because they will be subjected to intense scrutiny by the banks, the regulators, sophisticated investors. Any cracks, any inconsistencies, they'll find them.
And another interesting bit of advice was to approach their funding strategy as if the IPO isn't guaranteed.
Which is smart because, as the sources wisely point out, those IPO markets are inherently unpredictable. That window of opportunity can open and slam shut based on things totally outside the company's control.
So betting the farm solely on the IPO for future funding is basically a really dangerous gamble.
Exactly. And being proactive about public company readiness is also critical. This isn't just ticking legal boxes, it's having the internal systems, the controls, the right people in place to handle the demands of being public before you actually IPO.
Right, because being ready opens doors. Lacking it can have real consequences later.
For sure. And building relationships with the long-term shareholder targets, not just chasing the quick buck on day one, that's also highlighted as essential for, sustained success.
Okay, so the company is prepared, they're focused. Now, who are the key players actually guiding them through this incredibly complex process? The very heart of it, you've got the underwriters, right?
The investment banks, yeah. Their role is absolutely crucial and incredibly multifaceted. They essentially manage the entire IPO process, from the initial structuring advice all the way through the first few days of trading.
And that effort's usually led by the book runners.
Right, the lead underwriters. They take the primary responsibility for marketing the shares, building the book of investor demand, and ultimately pricing and allocating the shares. They're often helped by a larger group, a syndicate, of other banks, the co-managers, who help distribute the stock.
And these underwriters, they work super closely with the company to draft the key legal docs, the registration statement for the SEC, the prospectus for investors.
Hand in hand. The prospectus is that detailed disclosure document explaining the business, the financials, all the risks, the terms of the offering. It's critical. And the underwriters also organize and go with the company management on the roadshow.
Ah, the roadshow. That sounds like a whirlwind.
It is. It's this intense marketing tour. Executives and lead bankers presenting to potential institutional investors, think mutual funds, pension funds, hedge funds, trying to generate interest, answer tough questions, and fine-tune the price range for the shares.
And the underwriters manage all that, building demand, figuring out who gets shares, supporting the stock right after it lists.
Yep. They handle the complex allocation and support the stock's trading in the immediate aftermarket. And how do they get paid for all this?
Through the spread. Right.
Exactly. The company sells shares to the underwriters at a discount to the final IPO price, and the underwriters then sell them to the public at the IPO price. That difference is their compensation.
Usually a percentage.
Yeah, typically a percentage of the total money raised, often around 7% for many U.S. IPOs, but it can vary. And importantly, the underwriters have their own lawyers, separate from the company's lawyers.
Right, underwriters counsel. Why is that separation important?
Well, their lawyers play a vital role, especially in leading the due diligence process on behalf of the banks. They need independent verification.
Makes sense. So you have company counsel, underwriters counsel, both absolutely vital. Doing the exhaustive due diligence, drafting those complex legal documents, making sure everything complies with securities laws.
Step by step. And then you've got the auditors, the external accounting firm that audits the company's financials. Their role is also critical.
They provide that comfort letter.
Exactly, a comfort letter to the underwriters and the company. It basically gives the banks assurance about the auditor's independence, confirms they've reviewed key financial info in the registration statement, and vouches for the accuracy of the financial data based on their audits and agreed upon procedures. It's a crucial stamp of validation for the numbers investors are relying on.
Okay, so banks,
Yes.
lawyers, auditors, a whole team. Let's talk about the specific regulatory path here in the U.S. It's governed by some pretty foundational laws designed to protect investors.
Absolutely. The main law regulating the offering itself is the Securities Act of 1933. That mandates disclosure and registration. Then, the Securities Exchange Act of 1934 governs the secondary trading of securities, like on the NYSE or NASDAQ, and it imposes those ongoing reporting requirements for public companies.
And then there's SOX, Sarbanes-Oxley.
Right. Sarbanes-Oxley Act of 2002 came after those big accounting scandals like Enron and WorldCom. It significantly beefed up requirements for corporate governance, internal controls, and accountability for corporate officers.
So the core rule from the 33 Act is register with the SEC, right? Unless you have an exemption.
Pretty much. For an IPO, that means filing a detailed registration statement, usually an S-1 for U.S. companies, that discloses basically everything an investor would need to make an informed decision.
And here's where it gets tricky for companies during the process. This whole idea of an offer to sell.
Yep.
The SEC interprets that really broadly.
Very broadly. From the moment a company decides to go public until that registration statement is officially effective, there are strict rules about public communications. This is often called the quiet period, especially before the initial public filing.
So no hyping the stock beforehand.
Essentially, yes. Any communication that could be seen as conditioning the market, trying to drum up investor interest or anticipation, is restricted. And that includes stuff that might seem harmless, like a press release about a new product, or an executive giving a media interview about industry trends.
Even if they don't mention the IPO specifically.
Even then, yeah. If it could be seen as indirectly promoting the upcoming IPO, companies need extremely strict publicity guidelines during this phase.
Okay. And the IPO timeline generally has 3 periods.
Right. The pre-filing quiet period, which is super restrictive. Then the post-filing waiting period after the public filing, but before the SEC says, okay, you can do some things then, like distribute the preliminary prospectus. And finally, the post-effective period after the SEC gives the green light, when sales can happen freely. The communication restrictions loosen up gradually.
Got it. Now, a really important tool companies have these days is filing confidentially first.
Yes, that's become very common. They can submit their registration statement to the SEC privately.
Why do that? What's the advantage?
Several big ones, actually. Mainly, it lets them delay revealing potentially sensitive business and financial info, or even just the fact they're planning an IPO to competitors on the public for as long as possible.
Protects trade secrets. avoids revealing weaknesses early.
Exactly. It also gives them flexibility. They can go back and forth with the SEC staff, deal with comments and questions, all without the public clock ticking.
So they can time the actual public launch better, line it up with their readiness and market conditions.
Precisely. And critically, if the market suddenly tanks or they just decide not to go ahead for some internal reason, they can withdraw the confidential filing without the public ever knowing they were planning an IPO, reduces potential negative perception or speculation.
But it doesn't stay confidential forever.
No, absolutely not. That registration statement, including all the back and forth comment letters with the SEC staff, it must be made public at least 15 days before the company starts its roadshow. At that point, all those previously private details become public record.
Okay. Now, the due diligence process, you mentioned it earlier, sounds like one of the most critical parts of the whole prep.
Arguably, yes. This is where the underwriters, their lawyers, the company's lawyers, they dig incredibly deep to verify the accuracy of everything being presented to investors. It is unbelievably thorough.
What does that involve?
Well, it usually kicks off with detailed presentations from management covering like every aspect of the business operations, strategy, financials. Then comes massive documentary review, sifting through contracts, internal memos, board minutes, emails, you name it.
Wow.
Then there are countless Q&A calls, not just with management, but with the external auditors, maybe even key third parties like major suppliers or customers. The lawyers are laser focused on making sure every single factual claim in that registration statement can be backed up with solid evidence.
Sounds like it takes months.
Easily. Several months, often. And it all culminates in those legal opinions and the comfort letters we talked about. The lawyers issue formal opinions on things like the company's legal standing, the validity of the shares.
And the auditors provide their comfort letter on the financials.
Right. It's all about building layers of assurance.
So the IPO process itself is complex, time-consuming, expensive, but the journey doesn't actually end when the stock starts trading, does it? Life as a public company brings a whole new set of ongoing responsibilities.
Oh, absolutely. It's just the beginning in many ways. The most visible are those periodic reporting obligations to the SEC.
The 10Ks and 10Qs.
Exactly. Detailed annual reports on Form 10K, quarterly reports on Form 10Q. They have to provide comprehensive updates on financial performance, business operations, risk factors, management's analysis.
Plus current reports for big events.
Right, Form 8K. Required within just a few days for material events like signing a major contract, a change in control, a key executive leaving, keeps the market informed promptly.
And under Sarbanes-Oxley, the CEO and CFO have personal skin in the game.
They absolutely do. For domestic public companies, they have personal responsibility for the accuracy of the financials and the effectiveness of internal controls. They have to sign certifications in those reports saying everything's accurate and the controls work.
And there's potential legal liability if those certifications turn out to be false.
Serious potential liability. It adds a significant layer of personal accountability.
Public companies also face major corporate governance requirements, like independent directors.
Yeah, rules from the SEC and the stock exchanges like NYSE or NASDAQ require a majority of independent directors on the board, plus specific independent committees for audit, compensation, and nominating governance.
Are there exceptions?
There are some phase-in periods for newly public companies and exceptions for controlled companies where one shareholder has over 50% voting power or for foreign private issuers. But the overall trend and expectation is definitely towards strong independent governance.
And then there are the proxy advisory firms, ISS and Glass Lewis. They add another layer of pressure.
Increasingly, yes. These firms analyze company disclosures and governance, then issue voting recommendations to big institutional shareholders on things like electing directors, executive pay packages, shareholder proposals.
So even if a company follows all the rules.
Right. Even if they tick all the boxes, a negative recommendation from ISS or Glass Lewis can significantly sway how major shareholders vote. It adds real pressure and scrutiny beyond just the regulations.
Okay, so becoming public is this massive undertaking. Legal, regulatory, operational demands that just keep coming. But for our listener, the really critical question often boils down to that initial price, right? The IPO valuation. How is that actually determined? And does that valuation help or hurt the average investor buying in?
Yeah, that valuation piece is fundamentally critical. For everyone involved, the company needs to raise enough capital, obviously, but investors need a price that feels like a fair entry point, one where there's actually potential for future growth.
A good valuation builds confidence, attracts the right kind of investors.
Exactly, it sets the tone. And the sources talk about several factors that feed into setting that initial IPO price. Consumer demand for the shares is a huge one.
Meaning how much interest there is during the roadshow.
Right. If there's a ton of interest, the underwriters can often push for a higher price within or even above the initial target range. But, and this is important, high demand just reflects popularity at that moment. It doesn't necessarily say anything about the company's intrinsic long-term value.
Okay, so demand is one factor. What else?
Looking at industry comparables is key. How are similar publicly traded companies valued? This involves looking at metrics like price to earnings ratios, price to sales, price to book, comparing the IPO candidate to its peers.
And the company's growth prospects, future potential.
Heavily weighted, absolutely, especially for tech or biotech. And critically, the company's story or narrative, that plays a significant role, particularly for younger companies or those not yet profitable. The appeal, the vision.
And that narrative factor, that's where things can get a bit subjective, maybe even misleading for investors.
That's precisely the risk the sources point out. Companies gearing up for an IPO might, let's say, strategically enhance or embellish their story. Maybe bring in some well-known industry veterans onto the board for credibility, hire consultants to polish their image.
Make themselves look more ready, more poised for growth than they might actually be.
Potentially, yeah. The marketing effort around the IPO can sometimes overshadow or even distract from the true underlying business fundamentals.
Which is why it's so incredibly crucial, especially if you're thinking about investing early in an IPO, to look past the shiny story in the marketing. You have to dig into the financial statements yourself.
Read the risk factors in the prospectus. Understand the actual business model before you invest, especially with a company that doesn't have years of public track record you can analyze.
Yeah, the sources highlight that sometimes unprofitable businesses, companies that haven't proven they can actually make money, can still command these multi-billion-dollar valuations at IPO, based almost entirely on projections and future promises.
It can sometimes feel like management might be intensely focused on just achieving rapid growth almost at any cost in the run-up to the IPO, even if the underlying business model isn't quite profitable or sustainable yet.
Why? What's the incentive there?
Well, the incentive is that investors often reward that top-line growth over profitability initially, especially in hot sectors. And focusing on growth helps achieve a higher valuation for the IPO itself.
Which benefits the existing shareholders.
Yeah.
The founders, the early investors cashing out.
Exactly. As one slightly cynical investor source put it, if management thought the business was truly amazing and profitable right now, maybe they'd just keep it private and enjoy those profits themselves instead of sharing the pie through an IPO.
Interesting perspective. So what are the actual valuation methods the underwriters use?
Well, they use a mix, things like discounted cash flow, DCF analysis, trying to value the company based on the present value of its projected future cash flows. Price to earnings, PE ratios, comparing the stock price to earnings per share, though that's hard to use if the company isn't profitable yet.
Right.
And market capitalization analysis, often using multiples of revenue or EBITDA, especially when comparing to peers in the same industry. Understanding these methods, even just the basics, helps you as an investor assess if the proposed IPO price seems, within a reasonable ballpark based on traditional metrics.
The theoretical ideal is that perfectly valued IPO, right? Fair deal for everyone leads to success. But the reality sounds way more complex, often influenced by market sentiment, the seller's incentives.
Which brings us right to the heart of it for potential investors. Weighing those potential rewards against the very real risks, should you actually buy into the hype?
Let's start with the rewards, because that's what fuels all the excitement, right? The headlines, the big potential, the sort of lottery ticket aspect is the chance to invest in a company that just takes off, becomes a massive success story, delivers absolutely astronomical returns over many years.
Yeah, you think of the iconic ones, Amazon, Google, Netflix, Meta. If you got in early on those, the rewards were truly life-changing, no doubt about it.
And then there's the more immediate gratification, the IPO pop.
Ah, yes, the pop. It's a well-documented phenomenon in finance research. The stock price of an IPO often surges significantly on the very first day of trading.
Why does that happen? Underpricing.
Often attributed to underpricing, yeah. Where the IPO price is deliberately set a bit below where the true market demand might be, helps ensure a successful offering, generates positive buzz, creates momentum. The Pandora example from that Scandinavian study you mentioned earlier, perfect illustration. Its shares surged 25% on day one back in 2010.
Wow, 25% in a single day. That sounds amazing. And this is the huge counterbalance the sources keep stressing, that IPO top is strictly a short-term thing.
Strictly. It reflects immediate market demand, maybe that underpricing strategy, but it tells you absolutely nothing about the company's long-term performance, its future profitability, or whether the stock will actually be a good investment over months or years.
And this is where the risks, often kind of hidden by the hype, come into really sharp focus. One investor source framed this quite bluntly as the unfair trade argument.
The unfair trade. What's the thinking there?
Well, they argue that the people selling shares in the IPO, the founders, the VCs, the private equity firms, the early employees who've been grinding for years, they've waited a long time for this moment. The IPO is their main chance to cash out a big chunk of their investment and their hard work. It's payday for them.
Okay, makes sense. Their liquidity event.
Exactly. And because this is their big liquidity event, they have every single incentive to push for the highest possible valuation at the IPO. Maximize the cash they take off the table.
And they also know way more about the company.
Ask me more about its true state, its challenges, its real future prospects. Way more than any public investor buying shares on day one. They've lived it. They know the internal problems, the competitive threats, the real state of the financials beyond the polished story.
So the argument is their main focus at the IPO might just be maximizing the value of that specific transaction, getting the highest price, selling as much stock as the market will take.
Rather than necessarily optimizing the stock's performance for public shareholders over the next 5 or 10 years? Yeah, that's the argument. And adding to this feeling of an unfair trade, individual retail investors often just get the leftover share allocation.
The dregs, as they sometimes call it.
Yeah, exactly. After the big institutions have taken their preferred slice. So you might only be getting shares because the bigger players passed or got all they wanted. It can feel like you're starting from a position of like significant informational disadvantage and maybe misaligned incentives.
Which leads directly to that huge risk of overvaluation we touched on. The IPO price might just be inflated by clever marketing, an exciting story, or just riding a wave of market optimism, pushing it far beyond what the underlying business fundamentals actually justify.
Especially tricky with companies that aren't profitable yet, where the valuation is hanging heavily on those very uncertain future projections.
And the lack of established trading history just makes your analysis harder. You don't have years of stock charts, analyst reports, quarterly earnings calls to dissect like you do with a company that's been public for a while.
You're pretty much relying on the prospectus and the underwriter's research, which are kind of part of the IPO machine itself.
Exactly. Now, maybe the most sobering finding, the one that comes up again and again in the academic research the sources cite, is this pattern of long-term underperformance.
Yeah, tell me more about that.
Numerous studies going back decades, especially focusing on U.S. IPOs, have found that these stocks, on average, tend to underperform relative to comparable public companies or market benchmarks over a period of, say, 1 to 3 years after the IPO.
So after the initial buzz wears off.
Precisely. Jay Ritter's big 1991 study on U.S. IPOs was one of the first to really document the significant underperformance over a 3-year horizon. And think back to that Pandora example again.
The 25% pop on day one.
Right. But despite that exciting pop, its share price actually decreased by over 6% from the IPO price after 3 years, resulting in a significant negative adjusted return, meaning compared to the market of almost 27%.
Wow. So the pop is totally misleading for long-term holders.
In that case, yes. And this pattern, initial surge, then decline, or just lagging behind peers, it's not an isolated thing. It's a pattern found in many studies across different markets, too. The sources mention findings of underperformance in the UK and China as well.
Now, is it always the case? Does every study find underperformance?
Well, it's worth noting it's not always found to be statistically significant in every single study, and the methods vary. That Scandinavian study itself had somewhat mixed results depending on the exact performance measure used.
Yeah.
They found weak evidence of overperformance on one measure, but underperformance on another.
Okay, so some nuance there.
Definitely nuance. But the sheer volume of research, particularly focusing on U.S. IPOs, that points towards long-term underperformance relative to peers. That's a really powerful cautionary signal. It strongly suggests the initial hype often just doesn't translate into sustained outperformance for investors who hold on.
The sources also explored why this might happen.
Right.
What drives this underperformance? Behavioral factors.
Yeah, several potential explanations. One is investor overreaction and just pure over-optimism right after a high-profile IPO. The buzz inflates prices temporarily, way beyond fundamental value, sometimes called the impresario theory, like the marketing creates excessive enthusiasm.
What about earnings management?
That's another potential factor. Companies might use aggressive accounting, let's say, in the run-up to the IPO to make their results look as good as possible, boost the valuation.
But they can't keep that up indefinitely.
Exactly. Once they're public, maintaining that artificially boosted performance gets harder, leads to disappointment, maybe price drops later when reality sets in.
And then revisit that information gap we talked about, the asymmetry.
Right. The insiders, the sellers, they know the most. They're arguably more likely to decide to sell equity to the public via an IPO precisely when they think the market is overvaluing their company compared to its true intrinsic worth.
The price is high, it's a good time to sell some.
Basically. Then, as more information slowly trickles out to the public over time, that information gap narrows, and the stock price might drift down towards a more fundamentally justified level.
This also links to the windows of opportunity idea. Hot markets.
Yes. The studies suggest IPOs launched during periods of high market optimism, those hot markets when investors are maybe less critical, more enthusiastic. Those IPOs are more likely to be overvalued initially and then subsequently underperform long-term.
So getting swept up in a market-wide frenzy is a real risk for IPO investors.
It seems so. The Scandinavian study specifically found that launching in a hot market was negatively related to long-term performance.
Okay, so beyond these market-wide or behavioral things, there are also company-specific pitfalls, right? WeWork is the classic cautionary tale here, even though they pulled the IPO.
Oh yeah, WeWork. Highly anticipated debut back in 2019, huge valuation target.
But then the scrutiny started.
And significant issues surfaced. Big questions about its core business model. Was it really a tech company or just a heavily subsidized real estate firm? Profitability was a massive question mark, lost $1.6 billion in 2018 despite soaring revenue.
And huge lease obligations on the book.
Massive. Reportedly $47 billion in long-term lease obligations, plus serious corporate governance concerns, issues around the founder's behavior, potential conflicts of interest.
And all that scrutiny just collapsed the valuation.
Dramatically. From that initial target north of $47 million, it plummeted down to maybe $8 billion before they finally canceled the IPO altogether.
It's such a prime example of how, regardless of the hype, the fundamentals, the governance, transparency, a viable path to profit, they absolutely matter, and they will get exposed under the bright lights of the IPO process.
Definitely. Now, it's important we circle back to those big success stories, Amazon, Google, Netflix, Meta, because they are real. People did make fortunes. However, an investor source makes a really critical point about them. They are the exceptions, not the rule. There's a huge selection bias when we only focus on these companies that became global giants.
Many IPOs just don't achieve that kind of success.
Exactly. The source pointed to Dropbox is another example. Its shares actually lost 25% of their value in the 4 years after its IPO.
And critically, even for those companies that did become massive successes, a huge chunk of their incredible value growth often happened years after their IPOs.
That's the key point. The source noted that something like 90% of Google's total value growth happened 5 years after it went public.
Wow, 90%.
Yeah, which really underscores a vital lesson. The opportunity to invest in a truly great company doesn't necessarily vanish on IPO day.
In fact, maybe the better opportunity comes later.
For many successful companies, yes. The period after the initial hype has faded, after the business has had time to actually prove itself in the public markets, that might present better, more attractive chances to invest, sometimes even at lower valuations if the market has cooled off or gotten volatile. Patience can pay off.
Okay, so if many studies show this tendency towards underperformance, what factors might suggest an IPO has better prospects for long-term success? Did this Scandinavian study look into that?
They did. They looked for potential determinants beyond just that first-day pop and found some interesting correlations.
Like what?
Firm size seemed to matter. They found it was significantly positively related to long-term performance. Bigger companies going public tended to do better over time.
Okay, size matters. What else?
Firm maturity or age also showed a significant positive relationship. Older, more established companies tended to perform better after their IPO compared to very young ones.
Why would that be? Less uncertainty.
That aligns with the uncertainty hypothesis. Yeah. Investors just face less uncertainty about the future prospects and stability of a more mature business versus a very young startup with less track record.
And it's interesting that the companies in their Scandinavian sample were quite a bit older on average, right, than the companies in those earlier U.S. studies that found more underperformance.
Significantly older. Average age 24.7 years in the Scandinavian study versus 12.7 years in Ritter's 1991 U.S. study, or just under 9 years in a 2007 European study.
So maybe that difference in the type of company going public partly explains why the Scandinavian results were more mixed. Mature companies might be less prone to the issues that cause underperformance in younger, riskier IPOs.
That's a plausible explanation, yeah. Sample characteristics definitely matter in these studies.
Did they find anything else related to performance? What about debt?
Surprisingly, yeah. The degree of leverage, how much debt a company has relative to its equity, was associated with positive abnormal performance.
Positive. That seems counterintuitive. Isn't high debt usually seen as risky?
It is. The potential explanation they discussed relates to agency costs. The idea is maybe higher debt puts more pressure on management to operate efficiently, avoid wasteful spending, make sure they can service that debt, which ultimately benefits shareholders.
Interesting theory. Was it conclusive?
Well, the study's overall conclusion on agency cost theory was kind of mixed because other related variables, like how much ownership insiders kept, didn't show consistent significant relationships with performance. So a bit tentative on that one.
And did they confirm the hot market effect?
Yes, supporting the behavioral explanations, they found that being a hot market issue, launching during strong market sentiment or high IPO activity, was negatively related to long-term performance.
Oh, again, avoid getting caught up in the frenzy.
Seems like sound advice based on that finding.
What about ownership structure? Did things like how much stock insiders held on to matter?
In that particular study, those variables often didn't show a statistically significant relationship with long-term performance, which was actually a bit unexpected based on some theories about insider incentives signaling quality.
Okay. So pulling all of this together now, the market recovery, the incredibly complex process, the challenges of valuation, and these really well-documented risks and performance patterns. What are the absolute key takeaways, the essential lessons for you as an investor when you're thinking about an IPO?
That's the number one, absolutely has to be. Look beyond the hype. Just do not let the media buzz, the marketing machine, or the dream of a quick first-day pop be the main reason you invest. The excitement is real, but it just doesn't equal long-term returns.
Fundamentals matter, probably more than the story, especially over the long haul. You have to do your own homework. Dig into the business model. How do they actually make money? Is it sustainable?
Scrutinize the financials. Yeah, revenue growth is nice, but what about profit, cash flow, debt levels? Understand the competitive landscape. It takes real effort, especially because you don't have that long public history to fall back on, but it's essential.
And try to get some kind of handle on the valuation, even if it feels complicated. Understand the basics. Ask yourself, does this price seem reasonable compared to peers or based on fundamentals? Or does it feel stretched, based mostly on future hopes and marketing sizzle?
And be patient. This is such a hard one, right? Especially when you see those headlines about a stock popping 50% on day one. But the research strongly suggests the opportunity to invest in a truly great company often presents itself after the IPO.
Let the dust settle.
Exactly. Waiting lets you see actual performance data, see how management executes as a public company, and maybe, just maybe, invest at a more attractive price once that initial frenzy dies down. Remember, Google, 90% of the growth came later?
You also have to recognize the incentives at play, right? Understand that for many early investors and insiders, the IPO is the exit. It's how they realize the value they built.
And their goals at that specific moment might not be perfectly aligned with optimizing this stock's performance for you, the new public shareholder, 5 years down the road. Be aware of that potential misalignment.
And maybe consider the company's size and maturity, based on some of that research anyway.
Yeah, well, it's definitely not a guarantee. The study's suggesting that larger, more mature companies might present less uncertainty and potentially better long-term prospects compared to very young, small, maybe unprofitable ventures. That's at least a factor worth considering in your risk assessment.
And diversification. That seems absolutely non-negotiable when you're talking about high-risk investments like IPOs.
Oh, completely. Do not put a disproportionate amount of your investment capital into any single IPO. The risks of failure, underperformance, overvaluation, they're just too high. That slightly funny suggestion about putting $100 in every IPO, it's an extreme illustration of the principle of diversification, right? Spreading risk across many bets if you choose to play in this very risky arena, even if it's not a practical or proven strategy itself.
And finally, just be aware of the legal framework. Companies and the people involved have big responsibilities for disclosure. Material misstatements or omissions can lead to legal action from investors who feel misled.
And while there are legal defenses, like the due diligence defense for folks who can show they took reasonable steps to verify things, the possibility of legal issues just underscores how important accurate information really is.
So, wrapping this all up, what does it mean when you see that next big IPO headline?
While the U.S. IPO market, it's showing signs of recovery. There's optimism, activity in key growth sectors like healthcare and tech. It's a vital part of how companies fund their growth. But this deep dive into the sources, it really reveals a reality that's far more complex and, frankly, far riskier than that initial hype often suggests.
Yeah, the potential rewards are there.
Yeah.
That first day pop, the dream of finding the next mega cap stock.
Yeah.
They're real possibilities. But the documented risks are just so substantial.
Risks like those unfair trade dynamics, driven by information gaps and insider incentives, the significant potential for overvaluation, fueled by marketing and market mood swings, and critically, that historical pattern of long-term underperformance shown in so many studies relative to comparable investments.
And remembering that even the huge success stories, the Googles and Amazons, often saw most of their massive value growth happen years after their IPOs, suggesting patience might be a much better strategy than just chasing the debut.
And research hints that factors like a company's size, its maturity, maybe avoiding those hot market peaks, these might play a role in longer-term outcomes.
So, navigating this landscape, it really demands diligence, right? Focusing on fundamentals over the fanfare. Maintaining a healthy dose of skepticism toward the marketing blitz.
Absolutely. Understanding the complex process, the valuation factors, the historical performance data, the inherent risks, that's what empowers you to move beyond just reacting to hype, to make genuinely informed investment decisions for yourself.
So here's a final thought for you to chew on. Given this historical tendency for many IPOs to underperform long-term, especially those launched in really hot markets, and the evidence suggesting factors like company maturity and size might influence outcomes, how does this reshape your thinking? Is getting in early truly the best strategy, or is patience, analyzing a company after it's been public for a while, actually the more prudent path? And as the IPO market keeps evolving with new kinds of companies, new structures, how will these lessons from past cycles apply? What new factors might emerge that investors need to watch out for in the future?